Remember when central bankers said inflation was transitory? Well, 3 years later, global inflation is still running at 4.3%. But something weird is happening too.
Something really weird happens.
While most of the world fights rising prices, China is stuck in deflation. Prices there are falling, factories are drowning in overcapacity, and consumers won't spend. We've got a world splitting into two halves, one where prices won't stop rising and another where they won't stop falling. This is creating some of the strangest economic conditions we've ever seen, and nobody, not even central banks, knows how it will end. Let's investigate. My name is Guy, and you're watching The Coin Bureau. First things first though, nothing in this video is financial advice. We're just asking why your grocery bill looks more like a mortgage payment, while Chinese factories are practically giving stuff away for free. And if you want us to keep asking hard-hitting questions, then smash that like button, subscribe to the channel, and hit the notification bell. So, let's start with the inflation side of the equation. According to the latest OECD data, G20 inflation is still running at 3.8% and won't drop to central bank targets until at least 2026. That's 5 years after this whole mess started. 5 years of your money melting like ice cream in the sun. But to understand why inflation is so persistent, we need to understand what caused it in the first place. And no, it wasn't just money printing or supply chains or Fed easing. It was all of them hitting at exactly the same time. According to research from former Fed Chair Ben Bernanke and current IMF Chief Economist Oliver Blanchard, the post-pandemic inflation surge came from 3 enormous shocks colliding simultaneously. First, unprecedented fiscal stimulus, governments literally mailing checks to everyone with a pulse, and apparently even a few people without a pulse. Second, supply chain chaos that made everything from semiconductors to shipping containers as scarce as Bigfoot. And third, initially ultra-loose monetary policy that poured oil on an already raging fire. The fiscal side alone was extraordinary. The US government transferred trillions directly to households through programs like the CARES Act and American Rescue Plan, which put cash straight into people's pockets. According to the fiscal theory of persistent inflation, when government spending isn't backed by future tax increases, it creates permanent inflation. The price level has to rise to erode the real value of government debt. Then came the supply shocks. Pandemic shutdowns, labour shortages, and a certain Suez Canal blockage created bottlenecks everywhere. Research from the Eurozone shows these supply chain pressures were the primary driver of the initial inflation surge. Shipping costs 10x'd from $2,000 per container to $20,000. Suddenly, firms faced massive cost increases that they had no choice but to pass on to consumers. But while many experienced these supply shocks as crises, corporations exploited them as cover to juice their margins. A European Central Bank analysis found corporate profits accounted for 2/3 of Eurozone inflation in 2022 versus the historical 1/3. And just as supply chains started recovering, Russia invaded Ukraine in February 2022. To put things into perspective, Ukraine and Russia together supply about 30% of the world's wheat, 20% of its corn, and 80% of its sunflower oil. Russia alone provides 11% of global oil and 17% of natural gas. Now, a disruption to any one of these resource flows is bad news globally, and we got all of them. The war sent commodity prices into orbit. Oil hit $130 a barrel. European natural gas prices 10x'd, and the cost of food exploded. And according to a World Bank analysis of 5 decades of data, oil price shocks are the single largest driver of variation in global inflation. A Federal Reserve study estimated the war directly added 1.3 percentage points to global inflation in 2022. On a $100 trillion global economy, that's $1.3 trillion in extra costs. The combination of pandemic recovery demand and war-driven supply constraints created the perfect inflationary storm. And now, here's the fun part. Central banks saw all this happening and did nothing. For over a year, they insisted inflation was transitory. The Fed kept rates at zero and continued buying $120 billion in bonds monthly, even as inflation hit 7%. Their logic was that the supply shocks was temporary and would resolve themselves. Raising rates would only hurt the recovery without fixing supply chains. But by keeping monetary policy ultra loose, they let those shocks permeate through the entire economy. With money essentially free, fiscal stimulus translated directly into runaway demand. Labour markets went from crisis to boom almost overnight. By May 2023, OECD unemployment hit 4.8%, the lowest since the early 1970s. Job openings exceeded unemployed workers by record margins. Now, this should have triggered massive wage growth, but wages didn't even keep up with inflation. Real wages actually fell throughout 2022 and early 2023. A study by the US National Bureau of Economic Research suggests the tight labour market was partly an illusion. Unexpected inflation eroded real wages, incentivizing workers to job hop to restore their income. And this created statistical heat without actual wage pressure. But of course, everyone immediately compared this to the 1970s Great Stagflation, which, if you're not familiar with, you can learn about in our video down below. That whole decade was plagued by runaway inflation, slowing growth, and energy shocks, so the parallels with the present were obvious. But there are critical differences that explain why this is no 1970s rerun. First and most importantly, inflation expectations. In the 1970s, central banks were clueless and weak. They pursued wrong-headed theories, lacked independence, and caved to political pressure. When inflation hit, expectations became unanchored. Everyone expected high inflation forever, which became self-fulfilling. Today's central banks spent decades building credibility around 2% inflation targets. Despite inflation hitting 8%, long-term expectations barely budged from 2%. Markets believed central banks would eventually win, which prevented inflation from becoming permanently embedded. Second, economic structure. Advanced economies are far less energy-intensive today. It takes 50% less energy to produce $1 of GDP than it did in the 1970s. Capital and state forces crushed trade unions decades ago, neutralizing workers' collective bargaining power and giving rise to an extremely flexible labour market. The infrastructure for sustained wage price spirals simply doesn't exist anymore. And third, monetary response. Yes, central banks sat on their hands initially, but once they acted, they moved with unprecedented speed and force. The Fed hiked rates from 0% to 5.5% in just 18 months, the fastest tightening cycle in 40 years. The ECB, meanwhile, went from negative rates to 4%. So this wasn't the confused stop-start policy of the 1970s.
It's the place to be when you're in need of amazing crypto deals and opportunities. It's got savings that you won't believe, like money off those pesky trading fees. It's the Coin Bureau deals page. Sign up bonuses and discounts too. The Coin Bureau deals page. We put these deals together just for you, just for you.
But now let's flip to the other side of the story, China's deflation problem. While the rest of the world fights inflation, China is trapped in the opposite crisis. Consumer prices are barely positive at 0.7%, and producer prices have been falling for 2 years straight. And this isn't the good deflation of technological progress and productivity gains. This is malign demand-driven deflation, the kind that wrecked Japan in the 1990s and the world in the 1930s. The trigger was China's property market collapse. After the government's 2021 crackdown on developer leverage, the sector imploded. Major developers like Evergrande defaulted. Construction plummeted. Property prices fell 15 to 30% depending on the city. Now this matters because real estate represents 30% of China's economy and 70% of household wealth. It's like the 2008 US housing crash, except property is, or rather was, even more central to China's economic model. The wealth destruction has been catastrophic. Middle-class families watched their primary asset, their apartment, lose a third of its value. Consumer confidence collapsed. Retail sales growth has slowed to barely positive. Households aren't spending because they're terrified of what comes next. And Beijing's response has done little to help the situation. Instead of supporting demand by, for example, giving consumers money to spend, they doubled down on the supply side. The government directed enormous credit to manufacturing, especially in sectors like EVs, batteries, and solar panels. This contributed to significant overcapacity. China now produces far more than its domestic market can absorb. They make 70% of the world's solar panels, 60% of its EVs, and 75% of batteries. With domestic demand dead, the only option is to export this surplus at rock-bottom prices. But the property malaise isn't the only problem. China faces something called monetary disequilibrium. Despite the central bank pumping liquidity into the economy, households and businesses are hoarding cash. M1 money supply is shrinking even as M2 grows. It's a confidence crisis so deep that even monetary stimulus can't seem to fix it. The parallels with Japan's lost decades are impossible to ignore. Both experienced property bubbles that burst. Both saw households and firms focus on paying down debt rather than spending, what economist Richard Koo calls a, quote, balance sheet recession. Both initially responded with supply-side support rather than demand stimulus. But China's situation might be worse. Japan was already rich when its bubble burst, with GDP per capita close to $70,000 in 2025 dollars. Today, China's GDP per capita is only $13,000. Japan could rely on exports to the booming 1990s global economy, while China faces trade wars and protectionism. The biggest difference, though, is that China's structural imbalances are more extreme. Private consumption is only 38% of GDP in China versus 55% in 1990s Japan. Investment is 43% of GDP versus Japan's 32% peak. The adjustment required, shifting from investment to consumption, is thus monumentally larger. And the demographic picture is also a source of worry, as China's working-age population is already shrinking. The fertility rate has collapsed to 1.2 births per woman. The country is getting old before getting rich. So, can China's deflation spread globally? Well, JP Morgan estimates China's deflation could lower global core goods inflation by 70 basis points, which is significant but not catastrophic. This deflation transmission happens through three channels. First, the trade channel. Chinese manufacturers, desperate to clear inventory, are slashing export prices. Chinese export prices fell 5 to 10% last year, depending on the product. For competing manufacturers, this is a disaster. For consumers, it's a gift. Your next iPhone, EV, or solar panel will be cheaper thanks to Chinese overcapacity. Second is the commodity channel. China consumes 50% of the world's copper, 60% of iron ore, and 15% of oil. When Chinese demand falls, commodity prices crater. This is actually disinflationary for everyone else. Lower input costs for manufacturers, lower gasoline prices for consumers. And third, there is the financial channel. This is the smallest, but also potentially the most dangerous. Foreign direct investment in China has turned negative for the first time ever. Multinational profits from China are collapsing. If China has a financial crisis, the spillovers through the banking system could be severe. Still, China's deflation is unlikely to cause global deflation. Most economies are still fighting the opposite problem. What Chinese deflation does is make Western central banks' job harder. It provides disinflationary pressure on goods while services inflation remains sticky. Central banks have to pass whether falling inflation is from Chinese imports or genuinely cooling domestic economies. But beyond the obvious causes, there are structural forces creating persistent inflation that won't go away even if central banks crush demand. The ECB has coined 3 types of environmental-related inflation that are hanging over the global economy like a guillotine. First, climateflation, inflation from changing weather. Droughts destroy crops, floods wreck supply chains, heat waves massacre livestock, and all of this causes food prices to moon. The term heatflation describes how rising temperatures directly push up agricultural costs. And this is a global phenomenon that is well underway. Second, greenflation, inflation from the energy transition. Building renewable infrastructure requires massive amounts of copper, lithium, cobalt, and rare earths. Demand for these materials is exploding while supply remains constrained, making the path to net zero an inflationary one. Third, fossilflation. As investment in oil and gas declines, traditional energy supply becomes more constrained. Any geopolitical shock, like Ukraine, sends prices soaring because there's no spare capacity. This means we're more vulnerable to energy price spikes than ever. And then, to cap it all off, there's the long-term de-dollarization wildcard. As countries increasingly trade in yuan, euros, or their own currencies, demand for dollars declines. If the dollar loses reserve currency status, then America loses its ability to export inflation. Import prices would soar, interest rates would spike, and the Fed would face an impossible choice between defending the currency or supporting the economy. And these aren't temporary shocks that resolve themselves. They are permanent features of the new economy. Central banks can hike rates all they want. It won't make droughts less severe or lithium more abundant. Now, this split between inflation and deflation has created something unprecedented. Major central banks moving in completely opposite directions. The era of synchronized global monetary policy is over. The Fed and the ECB, having hiked rates aggressively, are now cautiously pivoting towards cuts. Not because they've defeated inflation, services inflation is still running at 4 to 5%, but because they're trying to engineer a so-called soft landing, bringing inflation down without triggering recession. Meanwhile, the People's Bank of China is desperately easing. They've cut rates, reduced reserve requirements, and pumped liquidity into the system. But it's not working. When confidence is shattered and debt burdens are crushing, cheap money doesn't stimulate spending. It's the classic pushing on a string problem. And then there's Japan, where the central bank is finally tightening after 3 decades of deflation. They've ended negative rates and yield curve control as the country experiences its first sustainable inflation in a generation, driven by tight labour markets and rising wages. While China falls into a Japanese-style trap, Japan is finally escaping one. And this divergence has turned markets into minefields. The synchronized global cycle that dominated post-2008 is gone. Every region now faces different challenges. US and European bonds might rally on rate cuts, but any inflation resurgence triggers a reversal. Chinese bond yields stay suppressed, while Japanese yields rise for the first time in decades. Stocks are equally mixed. Western markets are extremely overpriced, while Chinese stocks face structural headwinds. Currency markets show the messiest divergence, though, with the dollar weakening on Fed cuts, the yuan under depreciation pressure, and the yen potentially strengthening. So, what does this fractured global economy mean for crypto? Well, the setup is surprisingly bullish. First, persistent inflation. Despite central banks' efforts, inflation remains sticky above target. Fiscal deficits aren't shrinking. This Goldilocks inflation, high enough to erode cash but not high enough to trigger Paul Volcker-style 20% interest rates, is kind of a sweet spot for Bitcoin and other cryptos. Second, China's capital flight. As deflation worsens and the economy struggles, wealthy Chinese are seeking stores of value outside the mainland. Capital controls make traditional assets difficult, but crypto offers a backdoor. Third, policy chaos. Central banks moving in opposite directions creates volatility and uncertainty, exactly when crypto shines as an uncorrelated asset. When nobody knows if we're heading for inflation or deflation, the asset that doesn't depend on any single economy becomes increasingly attractive, be it gold or Bitcoin. Fourth, currency instability. Divergent monetary policies are setting up major currency volatility. In a society where fiat currencies are increasingly unstable and politicized, Bitcoin's neutral store of value becomes more appealing, even with its volatility. Best of all, the financial rails are being put in place to make these inflows easier. ETFs are getting approved left and right. The White House is shilling crypto, stablecoin regulations are being passed, custody rules are being clarified, you name it. The plumbing for large capital inflows is being built exactly when the macro environment makes it attractive. So, looking ahead, a few different scenarios could play out over the next 18 to 24 months. Scenario 1 is the soft landing. This is the consensus hope. Western inflation gradually moderates to 2% without triggering recession. China avoids a financial crisis but remains stuck in low growth. Global growth stabilizes around 3%. Markets rally on rate cuts and reduced uncertainty. And this is the muddle-through scenario where nothing gets dramatically better or worse. Scenario 2 is a global recession. Western central banks over-tighten, tipping their economies into recession. Alternatively, China's property crisis triggers a financial meltdown that spreads globally. Otherwise, it could be war or similar geopolitical shocks that tip everything over the edge. In this scenario, global growth turns negative, markets crash, and crypto goes down with everything else, before making a V-shaped recovery and blasting off as central banks panic and return to money printing. The third scenario is inflation reloaded. Just as everyone thinks inflation is beaten, it roars back. Maybe from new geopolitical shocks, maybe from premature central bank easing, maybe from fiscal populism as governments face elections. Central banks have to resume hiking. The higher for longer scenario becomes higher forever. Markets reprice violently. Bitcoin explodes higher as the inflation hedge trade returns with a vengeance. Now, in the first and third scenario, the case for crypto strengthens. We're already seeing crypto rally in the Goldilocks scenario, and the inflation scenario would take this rally into overdrive. And even if there is a recession, the resulting money printing is likely to benefit crypto in the end as well. Even so, the fact is, we're really in uncharted waters now. Half the planet can't stop prices from rising. The other half can't stop them from falling. Central banks that moved in lockstep for 15 years are now pulling in opposite directions. And we won't be returning to lockstep anytime soon because the forces creating this divergence, demographics, debt and deglobalization, are structural. The synchronized global economy of 2000 to 2020 is gone. We're entering an era of permanent fragmentation where every country and market follows its own path, placing immense stress on the existing global financial system. This, though, is unsustainable and won't last forever, but the resolution won't be pretty. Either inflation wins everywhere, deflation wins everywhere, or the system breaks and something new gets built. Whatever happens, it's going to be one heck of a show. And if you're wondering who's already planning for option 3, then check out our video on the World Economic Forum's Summer Davos, where, as usual, the mask was all the way off. As always, thank you for watching, and I'll see you next time. This is Guy, over and out.